You only need one trading strategy to become a successful trader. And in this video, we're going to cover that. First, we're going to go over the definition of order blocks, a mechanical way to identify order blocks. From there, we're going to go over the bullish variation of order block and then the bearish variation, and I'll give you some examples of them. Then we're going to deep dive into the trading strategy, covering two variations of the trading strategy. The first variation is a beginner trading strategy, and the second one is the advanced trading strategy. Then we're going to cover some risk management, how to properly manage your risk, and step-by-step guide to risk allocation. And then at the end, I'm going to give you some homework that you can do and share with me your results. So let's get into the video. So what are order blocks? First, we go over the bullish side and then we go over the bearish side. So a bullish order block is a down candle or candles prior to up candles that breaks the market structure's high. So here we can see that price has a range and then prices start to rally and breaks the market structure to the upside. As soon as these happen, the last down candle prior to the up move is going to be our bullish order block. Same things apply on the bearish side, but in opposite. So for the bearish order block, we have an up candle or candles prior to the down candles that breaks the market structure's low. Again, here we can see that price is in the range. Then price breaks the market structure to the downside. And once that happens, now we have a confirmed bearish order block. So now the question is, should we use the wick of the candle or the body of the candle when we marking out our order block? To make it simple, we categorize the candle into two sections, the long wick candles and the short wick candles. So if the wick of the candle is relatively long, we only use the body of the candle. In here, we can see that the wick of the order block candle is relatively long to the body of the candle. So that's why we cover the body of the candle. The other thing that you need to notice is that in a bullish scenario, we always mark our order block from the swing low, covering the lower wick of the candle, no matter how long that wick is. On the other hand, if the wick of the candle is short, we use the whole candle as our order block. Here again, we can see that we have a relatively short wick to the body of the candle, so that's why we cover whole of the candle as our order block. Going for some bullish example, here we can see that price is in a downtrend, and after some sort of a consolidation, price then rallies and breaks the market structure to the upside. This now confirms our bullish order block, which is the last down candle prior to the break of the market structure to the upside. Here we can also notice that we always cover the lower wick of the candle to the swing point. Then we can see that price returns back to the order block, and after retesting it, price immediately reverses and trades towards upside. Going for a bearish example, here again we can see that price is in a consolidation. Then we can see that price confirms the market structure break towards downside. Now we have a confirmed market structure break and we have a confirmed bearish order block on our chart. Again, notice that we covered the upper wick of the bearish order block no matter what. From there, we can see that price returns to the bearish order block, and from there, we can see that price reverses back towards downside and trades lower. Now that we know the step-by-step guide to identify the order blocks, it's time to go over our trading strategies. First, we're going to go over the beginner trading setup. So in the beginner trading setup, we use the order block on the same time frame that we find them. So here we can see that price breaks the market structure towards upside. As soon as that happens, we mark out our order block and then we wait for price to return to the same order block. That's when we're going to put our limit order and wait for it to get filled, covering the low of the bearish order block and targeting the recent swing high formation. And then from there, we wait for price to fill our order and hit our profit target. There are a couple of rules that you need to bear in mind. The first one is that price must break the market structure on closing basis. So what does that mean is that if we break the market structure only with the wick of the candle, that does not count as a market structure break, and we should wait for price to confirm the market structure break by closing the candle above the previous swing high. The second thing that you need to understand is that the setup must provide at least 2R risk to reward ratio. So what does that mean is that for every $10 that we're gonna spend, we expect a return of $20 if our profit target gets hit. And the last thing is that we have an early exit if the price closes below the 50% of the order block. Now let's go over some example. Going back to the same bullish example that we saw earlier, here we can see that we have a confirmed market structure break towards upside and we mark out our bullish order block. Then we can see that price returns back to the bullish order block, and as soon as we see that price is getting close to our order block, we then put our buy order and put the stop loss below the swing low of the order block, targeting the recent swing high, which needs to provide at least 2R risk to reward ratio. Then we can see that price, after retesting the order block, reverse and continues towards upside, hitting our profit target. So before we cover the advanced trading strategy, there is a concept that we need to talk about, and that is time frame relativity. There are two types of time frame. The first one is the higher time frame, which is used to derive our directional bias. In other words, where we anticipate the price is heading to. The second type is the trigger time frame, which is the self-explanatory. This is the time frame we execute the trades on. There is a relationship between the higher time frame and trigger time frame called time frame relativity. This relationship helps us to increase the probability of the trades being successful by having the most probable and logical expected reaction. Here you'll find the relative time frames table. This table provides a corresponding trigger time frame to the higher time frame that you choose to trade on. So for the daily higher time frame, the trigger time frame is going to be an hourly time frame. For the 4-hour higher time frame, we have the 15 minutes trigger time frame. And for the 1 to 2 hour higher time frame, we have 5-minute trigger time frame. We need to follow the exact same relationship between our higher time frame and the trigger time frame. For example, if we use daily as our higher time frame, then the hourly time frame is our corresponding trigger time frame. Once we go over the advanced trading strategy, you will understand this relationship and why it's so important. So now it's time to go over the advanced trading strategy. So for the advanced trading strategy, we first need to choose our higher time frame. In this example that we're going to go over, we're going to use the 4-hour higher time frame strategy. This time frame is really good and effective if you are a day trader. For the higher time frame, it's totally up to you which time frame you're going to go for. You can go with the daily higher time frame, 4-hour, or even hourly or 2-hour higher time frame. So the first step is to find an order block on our higher time frame. Here we can see that price has broke the market structure to the upside, and now we have a confirmed higher time frame order block. Then we wait for price to return to that same order block on our higher time frame. As soon as price retests that higher time frame order block, that's when we're going to zoom into our trigger time frame, which in this case is going to be the 15-minute time frame. On the 15-minute time frame, we can see that price has already retested the higher time frame order block. And then we can see that price has a really nice reaction, and we have already broken the market structure towards upside. Because of the market structure to the upside, now we have a confirmed bullish order block. Using the same entry technique, we put our buy order at the beginning of the bullish order block, and we put our stop loss below the swing low, targeting the swing high, which is going to provide at least 2R risk to reward ratio. Then we wait for our order to get filled and our profit target to get hit. Now let's go over a bullish example. We are on a 4-hour time frame as our higher time frame. Here we can see that price is in an uptrend by making higher highs and higher lows. With the last swing, we can see that price has a market structure break towards upside, which then confirms our bullish higher time frame order block. Then we wait for price to return to the higher time frame order block, and as soon as we get the retest of the order block, that's when we zoom in to our trigger time frame. Going to the trigger time frame, we have the same order block mark on the chart. And here we can see that price has already retested the higher time frame order block, and we have a confirmed market structure break towards upside. And because of that, we can mark our order block on the 15-minute chart. And we put our buy order with a stop loss and take profit. Then we wait for price to return to the order block. And here we can see that as soon as our order gets filled, price has a really nice support from the order block and we hit our profit target. We use the same technique for the bearish scenario, just in reverse. So now we're going to go over the most important thing when it comes to trading, and that is risk management. In order for you to become a successful trader, you need to have a proper risk management in place. There are a couple of rules that we're going to go over, and you need to understand them and follow them really well. So the first rule is that we do not risk more than 2% of our trading account on each trade. For example, if we have a $10,000 trading account and we want to risk 2% of that, that's going to be $200 per trade. So that means if we have a losing trade, we only lose $200 of that trading account. But remember, the 2% is the maximum amount of loss on each trade. My recommendation is 1% risk on each trade. The second rule is that the maximum daily drawdown is 3 losses. So that means that if we have 3 losing trades in one day, we stop everything and we shut down our PC and get away from our desk. And the last rule is that we only take the best looking trading setups. As you know, practice makes perfect. So I want you to go and do a minimum of 50 hours of backtesting before implementing this strategy in a live account. So what I want you to do is first pick your strategy. If you are a beginner trader, I highly recommend you to stick with the beginner trading strategy as it's much simpler and straightforward. But if you are a more advanced trader, go for the advanced trading strategy. Once you decide what trading strategy you want to use, I want you to put minimum 50 hours of your time going through the chart and implement the trading strategy. The reason that I want you to do this is it's a very effective way for you to understand the strategy and get familiar with the trading setup that you want to trade. And the second thing is that if you go over the chart and find this trading setup, you'll understand how powerful these strategies are, and that'll give you the confidence you need to use these trading strategies. So that brings us to the end of this video. Hope you found this video helpful. If you did, please don't forget to like and subscribe to the channel. And also, if you have any questions, drop them in the comment section and I'll answer them as soon as I can. Fantastic. Take care and peace out.